Restoration Hardware is going to be reporting earnings this week. We're going to talk about it today on Open Interest. Hello, everybody, and welcome. I'm Mike O. Welcome to Open Mic, where we talk about stocks and take your questions. So Restoration Hardware is going to be reporting earnings this week, and I think this is kind of an interesting one because this is a stock that fell precipitously the last time they reported. I think the stock had a down move of about 40. We'll pull up a chart of it, actually. I think the stock moved down something like 40% after they reported the most recent quarter, and I think I can stick this in here. Let me see if I can do that. So I'm just going to put the key events in. There we go. Yeah, so we had, this was after they talked a little bit about the last earnings. Big decline. You will notice the stock has clawed some of it back off the lows. Now, there was a bunch of different things going on here all at once. They had earnings which were bad. This also happened to coincide with Liberation Day, which was basically very punishing for all stocks generally. Now, this is kind of an interesting one to me because we haven't really favored consumer discretionary stocks very much for a host of reasons. And this one for even more reasons. So concerns about the economy, that's a problem. We have a very weak housing market. Gary Friedman, the CEO of Restoration Hardware, described this as the weakest housing market in the United States in 50 years. And when you're dealing with a company that sells home furnishings and things like this, just like Home Depot, just like Lowe's, they tend to benefit when people move. What's one of the first things they do? They fix up their house, they buy new furniture, they do all of these things. So all of those are going to weigh on the company somewhat. One of the key differences for Restoration Hardware versus, say, IKEA is that Restoration Hardware is a luxury brand. They sell expensive goods to an affluent demographic that, in general, isn't necessarily going to be afflicted by some of the other things that we've talked about when we've talked about consumer discretionary and when we've talked about lower-end retail. So I'm talking now about, Dollar General and things like that. So among the issues that we sometimes talk about is this bifurcation that we're seeing in consumer savings. So we see very high consumer savings, but if you're looking at people who are below the median, actually below average savings. So this is basically illustrating that there's a significant portion of the population that saw a big uptick in the amount that they had in available cash to spend, a function of two things: reduced spending in the initial stages of the pandemic, plus transfer payments, plus things like suspending, student debt repayments, and there were a lot of factors that led to higher cash balances for the bottom half, below median households, and that essentially has now been thoroughly erased. You add to this the fact that we have, I'm not going to call them super high mortgage rates, because if we go back to post-World War II, it's not as if the mortgage rates are ridiculous going back to that period, but certainly they are well above where they have been ever since the GFC. And so you put all of those things together, and it has certainly pressured the housing market in some areas. You compound that then with the impact potentially of tariffs, and I happen to just pull this up. This is from the company's most recent annual, or one of their more recent annual reports. They're referring now, of course, to the Biden administration, because the annual reports, they don't actually, we didn't have the Trump administration yet. But there were tariffs that were imposed in Trump 1.0 that the Biden administration decided to maintain. And they talk a little bit about the impact of that. They also talk a little bit about U.S. government import restrictions that were over here. You can find this on page 23 of the annual report if you decide to look at it yourself. We don't need to really delve into this too deeply. But it was not just tariffs. There were other essentially restrictions that were being imposed as a function of Chinese policies, in some cases towards some of their own people, for example. So basically penalties that were being imposed on imports as a result of Chinese policy that the United States didn't care for. All of that, I think, those concerns persist. But the thing that really caught my eye was actually their cash balance. So the projections now for the full fiscal year are still that the company is going to have positive free cash flow. But my concern here, and we can see over the last 12 months, it had negative $200 million in free cash flow. But I would like to just draw your time and attention to the following numbers. If you look over here where my cursor is, you're going to notice that the company had about $3.4 billion worth of debt for the fiscal year ended January 2022. It's about 3.9, round numbers, $500 million higher now. But the real issue is the cash and equivalents that the company has on hand. It was almost $2.2 billion at that time. And part of that was because, in the uncertainty that followed the pandemic, a lot of companies used that as an opportunity to raise cash because of the uncertainty. A very good and reasonable and prudent thing to do. However, how was some of this cash deployed in the period that followed? So we had a very strong housing market, a function of epically low interest rates, the lowest on record, that followed that pandemic as we had incredibly easy monetary policy. And so companies and individuals both were able to borrow, and the government too, of course, were able to borrow at very, very low interest rates. Now, there is a logic that corporate management could use that suggests that in an environment, if you can borrow money very cheaply, that maybe it makes some sense to borrow that money cheaply and deploy those borrowed funds to repurchase one's own stock. And indeed, that is what this company did. So had $2.2 billion, and we can see in 2023 that they had about $1 billion in open market share repurchases and another $1.25 billion in 2024. We can see that they still have almost $1 billion remaining in terms of the repayment, the repurchasing plan, but they do not have $1 billion on hand to actually execute that plan. And when you consider that, I think it was almost 70 million, I think. Yeah, there we are. So it was almost 70 million in negative free cash flow in the most recently reported quarter. I get a little uneasy about having $30 million in cash and equivalents on hand in that kind of an environment. So I want to put that out there as the backdrop before I then also point out that the company is otherwise trading at valuations that are relatively low compared to history. So we're just going to put in the price to forward earnings. I'm going to put a 5-year history on this. Why not? I'll draw a line so we can see this. So we're right around here, around 18 times. That, by the way, 18 times is cheaper than the S&P, considerably cheaper than the S&P, but it's not so cheap compared to other retailers, compared to other consumer discretionary stocks necessarily. So while it's cheap relative to its own history and it's cheap relative to the S&P, just bear in mind that for some of the reasons we've just outlined, it's not terribly cheap on that basis. And then we can just take a look at price to sales. I'm going to get rid of this annotation again. So get rid of this annotation. We'll get rid of the multiple to forward earnings. And I'm just going to go back actually a little bit further so we can really give this some context. And this is about where we are on a price to sales basis. Quick thing about price to sales. This is essentially the company's revenues or sales compared to their market capitalization. Arguably, we should be paying some attention to the enterprise value because as the equity has fallen, as their cash balances have fallen, and as their debt has risen, the total value of the enterprise is about $7.3 billion, right? So now what are we doing? We're basically taking the total value of the business, extracting any net cash or adding any net debt. So that just is making an adjustment for the value of the business to accommodate the fact that the capital structure of different businesses can be quite different. So when we look at all of this, it begins to make some sense that the options market is implying a very big move by the end of this week. So stock closed very close to $185, and we can take a look here, and we can see that the straddle is about 30 bucks. Let's just use that as a round number. So that's a move of about 16% higher or lower by the end of this week. We can move out to July regular way, why not? And here we can see that this straddles about $43 in round numbers, it looks like. So we're looking at a move of about 23% higher or lower. So that's the mean absolute deviation, round numbers, that you could expect. My thinking is that a lot of bad news has sort of been baked into this cake already. And so as I take a look at this term structure, I do think it might be tempting to contemplate using something like one of the strangle swaps that we oftentimes talk about. So I don't mind selling some of this near-dated premium, but bearing in mind some of those caveats that I just discussed. The company is more levered than it has been. Its valuation, it traded at a big premium because there was a lot of enthusiasm for the business based on the fact that they were appealing to that affluent demographic that I mentioned before. They are expanding into other areas, so they're taking a fairly creative approach. I mean, so they're selling home furnishings, but they're operating restaurants now. In fact, what I meant to show you guys, I actually went, so Restoration Hardware, I may have mentioned this on previous live streams, they're headquartered very close to where I live. So I live in southern Marin County, California. Their headquarters are in Corte Madera, which I guess is more sort of central, almost, it's the lower end of central or the northern part of southern Marin, just a couple miles up the road here. And they have one of their flagship stores very close by. So I actually rolled by there yesterday and took a couple pictures of the store, which I was going to show you guys. And then I forgot to upload them to the computer. So I just remembered only minutes before we got going. So bearing in mind all of these things that we just discussed, I don't mind selling these really elevated premiums, but you've got to buy some premium to hedge it in case they announce something that can cause one of these outside moves. So let's just take a look at what a strategy like that might look like. I had this, I thought I may have preloaded it into options play earlier. I did, but it logged me out because I waited too long. And so when we look at these kinds of strategies, just bear in mind that I'm usually going to look at selling straddles. So if we're going to be agnostic on direction, we're looking at selling strangles, that are the mean absolute deviation, anywhere from the mean absolute deviation to one standard deviation higher and lower. And the mean absolute deviation, as I've mentioned previously, is about 80% of one standard deviation. It's the standard deviation times the square root of 2 divided by pi, which is approximately 0.8. You can do that math yourself. It's actually 0.79, etc. But 0.8 is certainly close enough for our work. So what we're talking about in this case is selling the July 18s, which, as I previously mentioned, was about 40 some odd dollars. So if we go down to, let's call it the 145 puts, and we bump it up over here on the call side, we want to go up with kind of a similar amount. So that would be getting us up around 205, but we can go up to, we can actually, oh, this should be a sale, by the way. So we'll get up to, let's go up here around, I want to bump this up a little bit higher. I want to give myself a little bit more room to the upside. So I'm just going to take that up to about 240. That's actually 55 bucks out of the money to the upside. And again, these seem like big moves, I know that, but think about it this way. If the company had no leverage, right? So it's about 50-50 debt to equity right now. If I said the stock could move, call it 12% over the course of a month, you would say to yourself, okay, well, that doesn't seem like such a huge move, 12% in a month or more. It's actually slightly more than a month. Well, that's the way to think about that. When a company has a lot of leverage on the balance sheet, the equity is going to reflect the volatility associated with that leverage. So if it's 50-50 debt to equity, a 12.5% move in the valuation of the business will translate to a 25% move in the equity. So I hope that makes some sense. All right, so we're going to use September on the long side. That's going to capture our next earnings event. And we'll use the same strikes. You can tweak this as you see fit, if you like. A little bit agnostic to direction. I think the notion that the stock stays completely still is probably unlikely. The stock has obviously been very hard hit to the downside, so you'll notice that I'm giving myself a little bit less of a move to the downside in case they give us further disappointments. So a decline of 20%, again, is going to be a decline of about 12.5% of the enterprise value. Again, that incidentally, so this may or may not be interesting to you, but remember what I was saying before, trading about 18 times, and I was saying that on the consumer discretionary side, a lot of the retail names are actually trading cheaper than that, about 16 times. So if we go down to this lower level and we take our estimates down a little bit, that kind of gets us into that neighborhood. And if for whatever reason we get more of a positive surprise, then we're giving ourselves a very nice buffer there for that. So I hope that, that might be something of interest to you guys. I've really been going back and forth on this name, I have to say, but it is something that's really caught my time and attention. This, by the way, is also a Holly Index name. So it just so happens that my wife was in restoration hardware. She was actually returning things, so maybe that's not such a good thing. She was returning about $5,000 worth of stuff. But she loves this store. She loves the way they treat their customers. And, they have one of those return policies that is kind of reminiscent of, from a department store perspective of, like a Bergdorf Goodman's or Nordstrom's or Costco, where they just don't, they give the customers a really, really positive experience. And similarly, she had a very positive experience, returning those things. And we'll continue to shop there. Just so people are aware, this is not because we're buying and selling stuff for our own property. That's actually not the reason. My wife is in the real estate business, and they do a lot of remodels, on properties around the area, and oftentimes they use things from Restoration Hardware in those. So it has very much a Northern California kind of casual luxury vibe. So like their stuff. Okay, so with that, FinWest, you like to trade Restoration Hardware? Excellent. Okay, so you get some sense. I spent a lot of time going sort of back and forth on this. You might find this interesting if any of you guys happen to use any of the large language models, Chat, Grok, whatever. I asked each of them to make a bull case, make a bear case, just wanted to see what they pulled up. Their data is not completely accurate, by the way. One of them said the company had $2.2 billion worth of debt. I looked at that. I said, 2.2. It's got a lot more than $2.2 billion worth of debt. Not $2.2 billion worth of net debt either. It's $3.8 billion worth of net debt. So I don't know where those things are scraping up their data. So the only thing I will say, if you use those, just double check them. So they often have a source, but I mean, I was kind of dumbfounded. That's not close. We're talking about a $7.8 billion company, and they missed the debt number by about 1.6 billion. So not even close. Don't know, but not quite sure what that was all about. Okay, so PC says, Mike, what times during the day to avoid trading options? What times are best? What times do you trade? I believe you finish all that by 13:30 Eastern time. Excellent point. So there is an exception to this. I do use market on close orders sometimes in small size if I'm just looking to flatten something out. Wow, she uses stuff and returns it. Come on. No, that's not at all what we're talking about. No, she uses their stuff and installs it. But there are circumstances where it does not work in the space and they have to return it and get something else. So, yeah. I don't know what you're talking about there, Kenny Clutch. If that's what you do, I discourage the practice. So don't do that if that's your idea. Yeah, I don't, particularly I have to say, don't do that to retailers that we like, because that's going to make it impossible, right? So if people abuse the return policy at Costco, they're going to have to change the policy, and then it's not going to be good for anybody. So, oops, what is that all about? Sorry, I have to remember to shut that off. Okay. And yeah, by the way, you don't typically you don't install light fixtures, for example, and then return them. Once they're installed, they're installed. They either work in the space or they don't. So that's not how that works at all. Okay, so what times during the day to avoid trading options? What times are best, and what times do you trade? Okay, so sometimes, rarely, I use market on close. For delta hedging, it's usually between 1 and 2. Why between 1 and 2? Force of habit. So many years ago, we ran into an issue where we had people just sort of hedging at their discretion, usually based on a multiple of gamma. So for example, if you were long 4,000 gamma, someone would say hedge every single time you get 4,000 deltas, like that. We had a turn where we had a stock, doesn't matter, I might as well tell you, it was Tyco International. The stock was down precipitously in the pre-market. So the company had previously had a bearish piece written about it. This was late 1990s, I want to say. A guy named David Tice, he ran something called the Prudent Bear Fund. Yes, between 1 and 2 Eastern time. That's for the delta hedges, by the way. He had written a negative article about Tyco International. And several months after that, there was an announcement that the government was investigating the allegations that David Tice had made. And I can still remember, I was standing at the post, I was looking at the Instinet machine, so we had a dedicated Instinet machine at the time. And, you know, I saw the stock was trading probably around $38 a share or something like that. 38, it's 8.15, 8.20, 8.30. I look over, and the stock's trading $29 a share. So somehow, within minutes in the pre-market, the stock fell more than $8 a share. This was a sub $40 stock, so it was a big drop. And we had a decent amount of gamma, so we started hedging it. And one thing led to another. We bought a lot of the stock before the market opened. We bought a lot of it at 29, 28. Ultimately, the stock traded down to 22 in the pre-market, and then it opened on the big board at 26. And because we had repurchased so much stock at an average price above the opening print, the determination was made, you know what? We don't know more than the rest of the market does. So we're not going to trade in the pre-market anymore to hedge our deltas or after hours. Also, we were trading 10, 20,000 shares at a clip. So, you know, there's arguably, if we were trading, chances are we were the source of liquidity. And indeed we were. You know, I mean, for all the stock we bought above the opening print, we were the source of liquidity. Who knows who was selling to us? So anyway, we stopped doing that. And then we ultimately thought, this was when transaction costs were much higher, so we were paying Ready 1 3/4 cents a share or something like that. So I realized commissions are much lower now. We decided that hedging was a very expensive thing. We wanted to do less of it. And so we decided we were going to hedge discreetly once a day at 1:30 p.m. I don't know how that we arrived at that time, but that's what we did. And it's sort of been a force of habit ever since. So market liquidity is probably not going to be much of a consideration for most of you, meaning that you are not in a situation where you're going to be executing blocks of stock so large that you have to concern yourself with whether there's suitable liquidity at that time. Maybe that's not true for all of you, but it probably is. It's liquidity is not generally a concern of mine in my personal account. So that's something that really only matters on the institutional level. But I want to make the following point. Right before the close, it is not uncommon for some of the bids and asks to go away. We could do a whole show about why this is, but there's a lot of rules that encourage market makers to post more liquidity than they actually even mean to provide to the marketplace because of things like pro rata rules. So if an order comes in, how much of it do they get versus their competition and so on. So what ends up happening is that as the end of the day comes along, you will see that sometimes the bid-ask spread will widen, and you will see that liquidity starts to dry up. And you will definitely observe this on expiration Fridays. So we did a study at one point, and we noticed that SPX options prices were, on the close, about twice as wide in vol space as they were more than 15 minutes before the close. So it will cost you more to hit bids and lift offers generally at the close than it will well prior. So with that in mind, I would actually discourage you from trying to execute that way. Now, if you're trading SPX options, they're cash settled. So if you're doing 0 DTEs, the next question is, why are you even bothering to pay that away? Because you don't have to worry about exercise or assignment. So there's not going to be a settlement into the underlying issue to contend with. So something else to think about. Okay, so InvestWise. Hi, Mike. Also, your thoughts on Adobe and Oracle for earnings. Oracle, we actually talked about that on Friday. I think Mark Guthner. So I encourage you to go back and watch the office hours with Mark on that one. Let's just take a quick peek because I haven't actually double checked it today. Let's see where we're at in terms of our numbers. So we're looking at $6 for the full year. You can see this is when their fiscal year actually ends. So not an unreasonable multiple. And we are, what are we looking at here? Like a 1.5% free cash flow yield. What are we looking at for next year? $6.5 billion on 496. 1.3. 1.3% free cash flow yield. Good top line growth. I mean, this is a very reasonable multiple, I would say, assuming that they hit their numbers, because this at a sustained growth rate of north of 30% on the EPS side, why would we object to paying 29 times trailing earnings on that basis? Not bad. But the forecast for next year isn't as impressive, right? So if we're thinking about this, so 12% is what the street's looking for full year. That's the year that we're currently in because we just completed their fiscal year. So that works out to, what are we looking at here? 26.4 times 2% premium to the S&P, 2-turn premium, to the S&P. Yeah, I mean that's a reasonable valuation. Let's take a quick peek at it relative to its own history. Seems a little bit pricier than its own history to me by memory, but let's just quickly see. It is it's actually very rich relative to its own history. So that's a bit concerning. So 3 turns richer than the S&P, not unreasonable. But the S&P is trading a little bit rich to its own history. And if that forward, if there's any doubt shed on that forward earnings growth estimate, which right now is just shy of 12%. So this is pretty fully valued on that basis, right? So you're expecting 12% year-on-year adjusted EPS growth, and you're trading almost 28 times forward. It's getting up there. It's getting up there. What's the implied move on this thing? You know what? And let's give it the appropriate context. Let me pull unusual whales up for this. Quick point on unusual whales, because they mentioned this to me after the fact. I'm actually going to use a different browser for this so I can kind of keep track of things here. If anybody subscribed to Unusual Whales and the code did not work, or affiliate link code, which should give you a 20% discount, they said they will straighten that out. So I don't know if that's true for anybody. So Dix is not what I'm looking at. I'm looking for Oracle. So let's have a quick peek here. Yeah, not a really big implied move either relative to its history. So the last quarter they dropped 3%, but the one before 6.7, which is about what they're implying now, 6.5. But we can see that the 3 prior reported quarters, we got moves that were in the double digits, almost 12, 13, 11.5. So options very reasonably priced. If you own the stock, you know, I mean, obviously hedging gets expensive if you do it all the time, but buying a put spread here wouldn't be a terrible bet, just based on the fact that the multiple, you know, again, I like the company. Mark mentioned last Friday that he likes the company. But the valuation is a little bit worrisome based on their current growth, adjusted EPS growth assumptions. One takeaway I would quickly mention is that the stock price is suggesting that estimate is going to rise and not fall. Just based, you know, we can sort of see that that's what's implied. Okay, so let's just take a quick peek at Adobe while we're at it, because you were just asking. See what the implied move is there. We've had some pretty big moves in the history. So almost 14% to the downside last time, 13.7, 8.5. Wow. In the last 5 quarters, 8.5% is the smallest move we've seen, and it's implying 6.5 right now. Financials look decent, but let's take a look at these multiples. This is one of these things that ends up happening. You know, we've had a nice move in the market. You know, oftentimes what ends up happening is we get multiples. Maybe not here though, huh? Let's see. Let's go out 10 years and see where we're at. Now, why is that? So this one's trading cheap to the market. That's interesting. And to its own history. Let's have a quick peek at why that is. I have no position in Adobe. You're probably gathering that. I do use their products, by the way. As we all do. I'm sure a lot of you use things from Adobe for things like PDFs and whatnot, but I actually use Lightroom for my digital photographs. Believe it or not, I sometimes shoot film. I don't know if anybody else here does, but it just forces you to be a little bit thoughtful. And I kind of like the use of a mechanical camera. I have a fully mechanical camera. Same camera I had but was lost when I was a teenager. Went on a trip to France. I had a Nikon FM2, and it was stolen. Partially my fault because teenagers are not keeping really close attention to everything that they're doing all the time. And lo and behold, I did not pay very close attention, and we were on a tour bus, a lot of people on and off of it. We were using the same bus, but I left it on there. And we got off the bus, and when I got back on, it wasn't on there anymore. So much for that. But I did replace that. Did replace that camera, and I like to shoot it sometimes. Okay, so are they going to be able to regain confidence? So we have the consensus view is for a 13.3% increase in revenue in constant currency terms. That's pretty solid. That's better than this falls into that category of, is it better than the S&P? And the answer to that is yes. What about our adjusted EPS numbers? Those look pretty good. It is not trading right now as if the street believes that these numbers will hold up, because it is absolutely a decent do if this is realistic. Almost 10% top line growth year on year this year and next is what the street's looking for. 12% adjusted EPS growth. Technically, this thing must be floundering around here. So let's pull up the... So I haven't actually, I don't think I've showed this screen in the last couple of live streams, but I have done it in the past. I'm just going to remind everybody what it is we're looking at. So let me blow this up a little bit so we can just take a peek. So what I'm doing is I'm taking a 1-year history of a whole bunch of technical indicators that are tracked in Bloomberg. You can see that there's over 20 of these. Okay. Then what I did was I sorted by the best performing of them. Is that the right approach? I mean, there is a curve fitting element to this. I want to just mention that it's not necessarily always the best idea to say, okay, I'm going to look at each stock individually and say what was the best technical indicator for that stock, rather than saying what is the best technical indicator in general. I'm not a technical analyst, but this is just sort of a first cut at what the technicals might be saying. Take a whole bunch of technical indicators, look at which ones tended to perform the best over the course of the last year, and see where they're at right now. And as you can see over here, indicated by an up arrow or a down arrow. So if it's red, that means that the most recent trade indication was not profitable, even though over the longer term it has been. And then if it's pointing up, it's long. If it's pointing down, it is short. And if there is a blank, let's see, do we have any blanks? No blanks, interesting. Then in some cases you don't have any indicators at all. And we can actually see that history here. So the MACD has been the best performing by a decent margin over the course of the last year. And we can see right here, close and go short. It only just initiated this, only last week. So you can see here its history of technical indicators. So kind of a mixed bag on the technical front. Valuation, so let's just button up this whole Adobe conversation. Valuation looks fairly reasonable to me. I like that. Unusual whales code should be open interest, all caps, all one word. Okay, so for those of you who are using it, again, it may or may not be case sensitive, but if you tried to use it, didn't get your discount, you can let us know, or let them know. I'm sure they'll straighten it out for you. They're good guys over there, and they're not trying to screw anybody. It's machines that are doing this. They make, if you don't enter it exactly the way they want it, you'll get this kind of a situation. So buttoning up the Adobe conversation, options are reasonably priced if you are looking to make a directional bet. The stock seems reasonably priced, but it's trading as if people are expecting these estimates to go down, because 12% year-on-year growth, trading at 3-4 turn discount to the S&P and 10% top line growth, that doesn't make much sense. So when we look at these things, they're not reconcilable. In other words, if that were true, then it would be a massively better bet than the broad market. It is not performing the way the market is. It has been underperforming lately, which tells us that some folks are suspecting that those estimates are going to come in. Like I said, I don't have a position in it, so I haven't done that much of my own work to establish. I wonder if there's, you know what, let's just double check one last thing. Are there any sources of alternative data? So Bloomberg's second measure has Adobe's year-on-year growth below the industry, and SimilarWeb, so this is a new one on me, slightly better, but still negative. So these are things that might be driving things. You guys might want to take a look at that yourself. So SimilarWeb is one of the alternative data sources that doesn't give us great insights, great input in terms of their insights on Adobe's growth. But I will say this: I mean, if the numbers are legit, it's actually a very good value. Okay. Oracle was discussed on Friday's office hours around the 48-minute mark. Thank you to the crack production staff for identifying that. Okay. And what is the unusual Wales code? Yeah, it's open interest, all one word. I think all caps. It might not be case sensitive. So there's that. Link in the description. Yeah, link in the description to the video. Tucker D. Dog says, I think people finding better and cheaper alternatives to Adobe, Figma, Resolve, Canva, are better. And actually, this is a good point, too. You know, as these things get better, as these, you know, you get your Apple phone, and first of all, a lot of this software, so for example, on the video editing side, Final Cut was, and it was kind of an industry standard for a while. That was an Apple product. There's a lot of containers for digital content that were developed by Apple. And, you know, as these devices get better and better, and so the need to do, you know, we'll call it post-production work for editing, I'm ignoring things like PDFs. So I'm just talking about like on the content side for Adobe's products. As these things get better, the demand for Adobe services would drop. Resolve, which Tucker the Dog is referencing here, is a Blackmagic product. So that's going to compete with, I believe it's Adobe's Premiere or Premiere Pro, which I think is their video editing suite. So all of these things, you know, there's a lot of interplay in here. The other thing is that on the PDF side, it was always Adobe by default, even if it was just Adobe Reader. So people would publish in Adobe and then you'd read it in some of their free applications. But now you can print to PDF out of Microsoft and things like this. So it's a point well taken that there is a limit to how much in a competitive marketplace some of these things can charge. And in some cases, the things that they do are less important because they're getting some competition from other sources. And actually, I think on the video editing side, DaVinci's Resolve is very well thought of. And you know, it's also highly integrated. So Blackmagic does a lot of things, not just on the editing and software side, but on the hardware side. You know, the switching, the recordings, the cameras, and all that kind of stuff. So that can. So what is the most favorable time of day to trade SPX? I typically use credit spreads, but I've noticed that when the short leg moves in the money, my losses often exceed the credit received, Jasmine Joe says. So, yeah, my point on the SPX thing, so you're dealing with two different issues here. When I was responding to what is the best time of day to trade options, most of my concern was associated about whether or not the bid-ask spread for those options was wider than it would be at other times of day. That's just a disadvantage for all market participants. You essentially think about it this way: your transaction costs have gone up. If the bid-ask spread has widened, and in some cases that might be the only transaction cost you incur, because there are brokers that don't charge you a commission, because they get reimbursed in payment for order flow, which essentially is what the market makers reimburse to them for being able to capture the bid-ask spread. So you always want to try to trade when the bid-ask spreads are narrowest. Your question is a slightly different one, and that is you are saying you are noticing that when the short leg moves in the money, your losses will often exceed the credit received. Well, this makes sense. Why is that? Let's say I sell a call spread for 30% of the distance between the strikes. And now the underlying migrates through the through that strike. Well, first of all, you almost certainly are going to see losses instantaneously when that occurs, because what that's telling you is that the underlying has moved not in your chosen direction. If you sell a credit spread, unless you sold one that was in the money, and usually that's probably not what you're doing, that means that the underlying has moved against you. So the chances that you're going to see losses are certainly going to be greater at that point. They're going to be better than 50-50 because the stock has moved against you. In terms of your losses exceeding the credit received, well, that depends on how wide the spread was that you transacted initially and how much you collected to do it. So that's a slightly different issue, and for that I would probably consider stopping your losses. So how do I stop my losses? I've mentioned this before. And also, this goes on debit and credit spreads, by the way. People often ask, what is the threshold at which you usually adjust your spreads? And for me, that's usually when when one of the options is at least 60 delta. So if it's just a straight option and I'm long it and I was looking for convexity, I might look to roll when it gets to 60 delta. So if I had a 30 delta, 30, 40 delta debit option and it goes to 60, I might look to roll it. And that's partially because one of the reasons to have options is to have that convexity. On the short side, this still applies. And the reason would be if I'm short an option, if it's less than 50 delta, so let's say I sold a 30 delta option, or I sold a 20 delta option, it became 30, became 40. When it gets to 60 delta, that now tells you that there's a better chance than not that it's going to expire in the money. And that's not what you got into the trade for. So I think there might be a little bit of a trade management issue that you want to focus on there, Jasmine. I'm not sure I can give you a default time of day for that because, as JP Morgan famously said, what will the market do? It will fluctuate. Will it fluctuate higher or lower on any given day? I wish I had a hard and fast rule that said the market will always sell off after 3 p.m., but unfortunately I can't give you a rule like that because there isn't one. Okay, so I apologize. I wish I had a better answer, but if I had a better answer for that, none of you guys would actually need this because somebody would have pointed that out already. Sell the market at 3, and just like that rule that they say, sell in May and go away. Is it true that the market returns between Memorial Day and Labor Day have tended over the long term to be slightly worse than during other times? They have actually. Somebody just wrote an article about that. I don't remember who did. You'll have to look this up. But one of the reasons is because there have been a handful of times when returns were much worse. And if you take a look, the amount of difference that actually makes is relatively small. So I'm never crazy about these rules that people have, whether it's time or date based, seasonal. Other than for me to say that I will say at the end of the year, things, going into the Christmas holidays, they often tend to be pretty good. I'm not crazy about selling the market then, but or after elections, very oftentimes people get optimistic after elections, almost regardless of who wins for whatever reason. Eric M. Intuitive Surgical took a bit of a hit today on a Deutsche Bank downgrade. Not sure I'm convinced, so would think of adding any thoughts. So I have said this before, and I will say this again, and that is that I usually like to watch how the stock behaves for a couple of days after you have a gap. And the reason for that is that oftentimes institutions cannot act as quickly as self-directed retail market participants can. And so my interest is in determining whether discretionary active managers, people will say, well, why is there, why is Steve Grasso often talks about the 3-day rule. Is it a 3-day rule? Well, it's not so much a 3-day rule. It's what you're trying to find out is, let's take a look at the biggest holders here, right? So Fidelity Management Research, T. Rowe Price, okay? So what do these two have in common that is separate from Vanguard Group? Vanguard is mostly indexing, okay? So indexing means that it's strict rules-based. You buy the S&P 500 index fund and you have, you weight things accordingly. BlackRock, largely ETFs. Again, these are passive investments. So these are two big passive investors. T. Rowe and Fidelity are active. So the question we want to ask ourselves is, are these active, what we call real money accounts, going to start unloading some of their substantial positions? And they are substantial. And usually it's going to take a little bit of time to see whether they start entering the market and trying to hit bids. So that's one of the reasons why I often usually like to wait a few days before I make that determination. So give yourself some time to digest the news, give them some time to digest the news. And, the real question you want to ask yourself is, and this is, it's a discount, but is it a huge discount? Let's just take a look at it from a historical perspective. It's not like the stock dropped 30%. We're down 6% today. So let's just look at this, give it some historical context, and say, okay, so this is the gap you're talking about. Do you need to race in and buy more of it because you got a 5 or 6% discount? I don't know. I don't think you need to. I think you could probably wait a couple days and just see how people respond. That would be my 2 cents on that. Michael Anthony, looks like Albertsons is a buy since it has 2,200 stores of people buying food from them. So it's interesting. Albertsons and Kroger's. I've mentioned these guys. Kroger. It's interesting because I think the first time I mentioned Kroger's on the channel, it was trading. I'm going to say it was between 10 and 11. It's closer to 15 now. And these are not growth stocks, but they were cheap enough that I thought, okay, I'm kind of on board with that. So in Albertsons' case, these things tend to have yield. This one is still trading around 10 times, unlike Kroger's. So I'm kind of with you on this. Is it an exciting stock? No, it's not. And as you guys know, I usually, if I'm going to go out and pick single stocks, I want them to be growing the top line faster than I think the S&P is likely to grow revenues, EPS growing faster. That's not the case here. But at 10 times earnings, if your logic is you want yield and you want to be exposed to staples and some stability, yeah, I'm on board with that. That's fine. Okay, I think I skipped over something. Let me just double check. So James Forbin, you said, would a vertical call credit spread 240, 260 work July 18th? I'm assuming you are referring to Restoration Hardware here. And yeah, so that's another way that you could sell some upside in Restoration Hardware if you were so inclined going into earnings to collect some of that elevated premium while capping your risk. So that is an approach that you could take, yes. As you notice, though, with the trade that I articulated, I was kind of looking for a little bit of a windfall in the event that it did move to the upside or did move to the downside, partially because I'm expecting some movement. So while I am selling near dated premium, it's with the idea that I could capitalize on some movement, if that makes sense. Whereas just selling an upside credit spread, what are you hoping? That the stock either stays right here or declines. If you sold it downside put credit spread, same thing. You're hoping that the stock stays right here or appreciates. If you do a strangle swap, you are not hoping that the stock stays right here. You're also hoping that it's not going to blow way the heck out one way or the other. But the peak profits actually Yeah. So I mean, the trade that, and as you, where's that? I have that up here. Let me see if I can pull it back. Where? It probably lost the trade because it logged me out already. Is it going to remember my trade? Yeah. So, here's an interesting point too, by the way. You're going to notice that the preferred trade that Options Play came up with is bearish, and that's basically because of the technical issues that are going on here, and it has some resistance. So buying a put spread and selling a call spread are basically the debit and credit versions of each other. So again, that's totally fine, but I just wanted to make that important point, distinguishing the thing that I talked about earlier from what you're proposing, but that's probably fine. Let's see. We went through this. We went through Adobe. We talked about Intuitive. 60 deltas, exit or roll, managed trade. Yeah. So that's how I tend to do it. Everybody's going to have a slightly different approach, but that's my thinking on that. And actually, look at this. We've already chewed up very close to the hour. How did that happen? Probably because I started talking about cameras and my trip to Restoration Hardware. That I ended up using up more time than I thought. And I thought there was another page here. Did I miss a page? Okay. I may have I thought I had missed a page of comments, but I don't think I did. Okay, so just to button up this conversation, Restoration Hardware, big implied move. A big implied move is justified for two reasons. It has had very large moves recently, double digits, 40% to the downside most recently, and there's a lot of leverage. It's about 50-50 debt to equity, but it is also getting closer to the cheaper end of its historical multiple. They do serve an affluent demographic. I was sort of playing on that strangle swap idea because I think if they do come back with some positive cash flow numbers, I said if they do, because they had negative 70 million, almost 69.7 by memory, last quarter, then that could straighten out my biggest concern, which is that fact that they only have $30 million in cash and equivalents on hand. Otherwise, I think it's kind of an intriguing situation and cheaper than it has been. Albertsons, I mean, that's hardly exciting, but it's probably quite safe. So I think we can say that. Oracle, I like the way they're managing their business. Top line and EPS growth numbers are very good if they hit their numbers. No reason to think that they won't, but they are trading above their historical turn, and next year's forecast is going to have to, in my view, be better than the 12% that the street is estimating, or it's going to be it's tough to see how much more appreciation you could squeeze out of it. Other than the fact I think the company is well managed, in the right places and all that kind of stuff, it is looking kind of fully valued, and the options are not overly priced, so if you wanted to hedge that, not a bad move. So I hope you guys found this helpful. We will be back on Wednesday and talk about some of the economic announcements and some other earnings and things that are coming up. I wanted to make the following point, which is that my sister is getting remarried, so while I am going to actually still be in California because we have other family things going on and I can't break away, somebody else on the production staff will not be around on Friday, unfortunately, to do the show. So we are not going to be doing office hours on Friday the way we normally would, because some of the people that are involved with the production of this program are going to be heading to Vermont. So we will see you all here on Wednesday. Thanks for watching.